In 2016, Wells Fargo revealed that its employees had opened more than 2 million fake accounts in customers' names without their knowledge. The fallout was catastrophic. Congressional hearings, a $185 million fine, and the resignation of its CEO. In 2018, the Federal Reserve did something it had never done before to a major bank. It capped Wells Fargo's total assets at $1.95 trillion, essentially putting a governor on the engine of the fourth largest bank in America.
That cap stayed in place for nearly 7 years, and then in 2025, the Fed finally lifted it.
Which makes Wells Fargo, right now, one of the most interesting stories in American banking. The handcuffs are off, the transformation is underway, and Q1 2026 was supposed to be the moment the market got its first real look at what an uncapped Wells Fargo could do.
Instead, they delivered a double miss. EPS came in at $1.56 adjusted against a $1.58 estimate, and managed revenue hit $21.4 billion versus the $21.8 billion Wall Street was expecting.
So is this a stumble or a warning sign? Today on Charged Alpha, we go deep on Wells Fargo, the numbers, the narrative, and what to watch. I'm Hudson Thomas.
And I'm Lana Chen. Let's get into it.
Before we get into the quarter, let's set the stage on what Wells Fargo actually is, because it is a genuinely massive institution. Founded in 1852 by Henry Wells and William Fargo during the California Gold Rush, the company started as a banking and express delivery service for the American West. Today, it is headquartered in San Francisco and serves approximately 70 million customers through roughly 14,700 branches nationwide.
It operates through 4 primary segments. Consumer banking and lending covers the retail customers, checking accounts, mortgages, auto loans. Commercial banking handles middle market businesses. Corporate and investment banking is the Wall Street-facing side. And wealth and investment management rounds it out with advisory and brokerage services.
So it is a true full-service bank, not just a consumer lender, not just a trading house. It is an institution with its hands in almost every corner of the financial system.
The competitive moat here is real. You have a nationwide branch network that is extremely expensive to replicate, one of the deepest retail deposit franchises in the country, and the kind of brand recognition that comes from over 170 years in business. Customers are sticky in banking, switching costs are high, and Wells Fargo has that inertia working in its favor.
There are roughly 217,000 employees. Market cap sits around $250.8 billion. And the stock has a beta of about 1.1, so it tends to move a bit more than the broad market. That is your company overview. Now let's talk about the person running this turnaround, because the CEO story at Wells Fargo is genuinely compelling. Charlie Scharf took the helm in October 2019, recruited specifically because the board needed someone who could deal with regulators, rebuild internal controls, and restore the bank's credibility without burning the whole thing down.
His resume is legitimately impressive. He spent more than a decade at JPMorgan Chase under Jamie Dimon, where he ran retail financial services. Then he was CEO of Visa from 2012 to 2016, then CEO of Bank of New York Mellon before landing at Wells Fargo.
What is interesting about Scharf is that he came in with zero attachment to the old culture. He moved the company headquarters functions from San Francisco to New York, overhauled the entire risk and compliance infrastructure, and systematically worked through the regulatory consent orders that were hanging over the bank. Wall Street has been patient with him because progress has been steady, even if slow.
The efficiency ratio is the key metric on his operational agenda. It measures operating expenses as a percentage of revenue. Lower is better. When Scharf arrived, Wells Fargo's efficiency ratio was in the mid-60s. His target is around 54%. At Q1 2026, the bank was around 63%. Still work to do, but the direction is right.
All right, Lana, time for the numbers. Walk me through it.
Let us start with valuation. Wells Fargo trades at 11.9 times trailing earnings and 11.7 times forward estimates. Price to book is 1.45 times. Price to sales is 2.0. EV to EBITDA is 18.7 times. For context, JPMorgan Chase trades at about 14 times earnings and over 2 times book. Wells Fargo is genuinely cheap relative to its mega bank peers.
And that discount exists because of the regulatory history.
That is a big part of it. The market has assigned a haircut to WFC's valuation for years because of the consent orders, the asset cap, and the uncertainty around the transformation timeline. The question now is whether that discount starts to close as Scharf delivers results.
Got it. What about the income statement?
For Q1 2026, managed revenue, that is net interest income plus non-interest income, came in at $21.4 billion. Net interest income specifically was $12.1 billion, which is up 5.2% from $11.5 billion in Q1 2025. That is the single most important number at Wells Fargo right now. NII is the engine.
And NII is basically the spread between what the bank earns on loans and what it pays on deposits.
Exactly. With rates still elevated, that spread is wide, and Wells Fargo is earning well on its loan portfolio. The concern is what happens if the Fed cuts aggressively. WFC is an asset-sensitive bank, meaning its NII benefits from higher rates and would face pressure from cuts.
What did net income look like?
Net income was $29 billion for the quarter. Adjusted earnings per share came in at $1.56. Return on equity for the trailing 12 months is 11.8%. Not spectacular for a megabank, but improving. Gross margin, using NII as a proxy, is approximately 56% of managed revenue.
What about cash flow in the balance sheet?
Wells Fargo is generating approximately $21.7 billion in operating earnings on a trailing 12-month basis. The balance sheet is colossal, total assets of $2.2 trillion following the asset cap removal. Stockholders' equity is $100.3 billion. They carry about $450.6 billion in total borrowings, which sounds large but is entirely normal for a bank of this scale. Cash and liquid assets are approximately $110 billion.
And capital returns?
Strong. They bought back approximately $3.5 billion of stock in Q1 2026 alone and pay a $1.80 annual dividend, currently yielding about 2.15%. The payout ratio is under 30%, leaving substantial room for continued buybacks as earnings grow.
So overall picture?
Overall, Wells Fargo's financial health is watchful. The bank is executing its transformation well. NII growing, capital returns robust, balance sheet expanding post-cap removal. But the Q1 miss on both top and bottom line introduces some caution, and the NII growth guidance for the full year is more modest than the market had hoped.
What is Wall Street saying about Wells Fargo?
The consensus is broadly constructive. Of 24 analysts covering the stock, 15 have buy-equivalent ratings, 7 are at hold, and 2 are at sell. The average price target is $89, which implies about 9% upside from current levels. The range is wide, low of $70, high of $115, which reflects genuine disagreement about the pace of the transformation.
Who are the most bullish?
Goldman Sachs has a buy with a $97 target, arguing that the asset cap removal unlocks multi-year NII growth that is not fully priced in. Evercore ISI is at outperform with $95, saying the transformation story is still in its early innings. Piper Sandler and Barclays are both at overweight.
And the skeptics?
JP Morgan is at neutral with an $82 target, basically saying current levels are fair value, and the NII outlook is uncertain given tariff-related macro risks. Baird upgraded from underperform to neutral back in February, a constructive move, but they are not fully in the bull camp yet.
The Q1 miss must have shaken some confidence.
Modestly. The miss was not catastrophic. We are talking 2 cents on EPS and $346 million on revenue. But in a quarter that was supposed to validate the asset cap removal thesis, the market wanted more. The stock pulled back, and some analysts trimmed their near-term NII estimates.
All right, bull and bear. Let me take the bull side first. The single most important bull argument for Wells Fargo is the asset cap removal. For 7 years, this bank was legally prevented from growing its balance sheet. JP Morgan could grow. Bank of America could grow. Wells Fargo had to run in place. That constraint is now gone, and the bank has the distribution, the brand, and the deposit base to deploy capital at scale.
And the NII data supports that. Even before the full benefit of an uncapped balance sheet kicks in, NII was already growing 5.2% year over year in Q1. As WFC grows loans and adds assets, that number should improve.
On top of that, the valuation is legitimately attractive. At 1.45 times book, you are paying less than $1.50 for every dollar of equity in this bank. JP Morgan trades at over 2 times book. If investors regain confidence in WFC's franchise, there is meaningful re-rating potential, not just earnings growth, but multiple expansion.
The bear case starts with that Q1 miss. It was a double miss in a quarter that was supposed to demonstrate the post-cap firepower, and that is not a great look. More importantly, the full-year NII guidance of 1 to 3% growth is modest. After 7 years of waiting for the asset cap to come off, investors expected more than low single-digit NII growth in year one of freedom.
What about macro risks?
That is the other bear argument. Wells Fargo has significant commercial and industrial loan exposure. If tariffs trigger a recession or credit quality deteriorates, the provision expense goes up and earnings come down quickly. Net charge-offs in Q1 were 24 basis points of loans, not alarming, but worth watching. And there are still 7 active consent orders with regulators. The bank has made progress, but the regulatory tail risk is not zero.
Fair. 2 genuinely balanced arguments. How does Wells Fargo stack up against its mega bank peers?
Let us run through the 3 obvious comparisons. JP Morgan Chase is the benchmark, trades at 14.2 times earnings, 3.8 times sales, and has been growing revenue at about 8.5% year over year. JPM operates the best franchise in banking and deserves its premium. Wells Fargo, at 11.9 times earnings and 2.0 times sales, is meaningfully cheaper. That is the discount to quality trade.
And Bank of America.
BAC trades at 13.1 times earnings and 3.1 times sales, with revenue growth around 4%. It is probably the most direct peer, similarly NII sensitive, similarly mid-transformation, and similarly trying to grow into higher rates. WFC trades at a bigger discount to BAC, which is interesting given that WFC's NII growth rate in Q1 was actually better.
What about Citigroup?
Citigroup is at 12.5 times earnings and 1.8 times sales, so it is actually slightly cheaper than WFC on PS. Revenue growth around 3.8%. Citi is also in transformation mode under Jane Fraser, and its stock has a similar turnaround discount baked in. The key difference is that WFC's domestic retail deposit franchise is far superior to Citi's globally diversified but messier model.
So the takeaway from the peer comparison?
Wells Fargo screens as the cheap option in a sector of reasonably valued banks. Whether that cheapness is a trap or an opportunity depends almost entirely on your confidence in Charlie Scharf's execution and the macro environment for credit quality.
What was the options market saying about WFC heading into earnings?
Positioning was roughly balanced. The put-call ratio came in around 0.95, nearly 1-to-1, which suggests the market was not particularly directionally positioned. IV percentile was at 52%, reflecting moderate uncertainty without the kind of elevated fear you would see before a high-stakes print.
Where was the open interest clustering?
Call open interest was concentrated around the $85 strike, suggesting bulls were targeting a move toward the upper end of recent ranges. Put protection was clustered around 75. The implied move heading into earnings was approximately 3 to 4%, and WFC did pull back in that range after the double miss. The options market got it roughly right.
Any notable insider moves at Wells Fargo?
Modest activity overall. 2 directors made open market purchases of WFC shares in early 2026. Those are generally read as constructive signals of confidence at current valuations. On the other side, 5 executives conducted sales under pre-established Rule 10b5-1 trading plans, which are scheduled in advance and do not carry much informational content. Net insider activity is slightly constructive given the director purchases.
What are the main risks and things to watch with Wells Fargo?
4 key watch points. First, credit quality. Provision expense and net charge-offs will be the leading indicator if the economy softens. Any meaningful deterioration in commercial real estate or C&I lending would hit earnings quickly. Second, NII sensitivity. Wells Fargo is asset sensitive, meaning rate cuts hurt. The Fed's path matters enormously here.
What else?
Third, the efficiency ratio. Scharf is targeting around 54%. At 63% currently, there is still a lot of work to do, and expense discipline will be critical to margin expansion. Fourth, the regulatory tail. 7 consent orders is 7 too many for a bank trying to rebuild trust. any new enforcement action, even a relatively minor one, would set back the narrative.
Key catalysts on the positive side?
Full quantification of balance sheet growth now that the cap is gone, additional consent order resolutions, especially if major ones come off before year-end, and any upgrade cycles from currently neutral or hold-rated analysts who are waiting for proof points on NII growth.
Bottom line on Wells Fargo.
Wells Fargo is the great American banking comeback story in slow motion. Q1 2026 was not a disaster, but it was not the validation the market wanted either. Adjusted EPS of $1.56 and managed revenue of $21.4 billion are solid numbers in absolute terms, but missing estimates in what was supposed to be a breakout quarter stings a little. The underlying NII trend is constructive, the capital return program is generous, and the valuation is cheap relative to peers. The thesis depends on patience and execution.
If you are tracking this name, what is the one metric that matters most?
Net interest income. Every quarter, watch whether WFC is growing NII, specifically the trajectory against their full-year guidance of 1 to 3% growth. If they come in above the high end of that range, the thesis is accelerating. If they miss guidance, the cheap valuation becomes a value trap conversation. NII is the yardstick.
We like to close every episode with a quote that captures the essence of the company and the moment. For Wells Fargo, this one from Warren Buffett felt exactly right. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you will do things differently.
That quote might as well have been written about Wells Fargo specifically. 164 years of banking history, erased from the front page in 2016 by an incentive structure that went badly wrong. The work of rebuilding that reputation is exactly what Charlie Scharf has spent the last 6 years doing.
And hey, if you want to run the same research workflow we used to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there, waiting for you to run your own screens. Check it out.
Great tools.
That's going to do it for this episode of Charged Alpha, a deep dive into Wells Fargo and Company. Thanks for listening. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.